Okay, let's unpack this. Imagine a high-stakes financial chess match playing out right now.
Not on a board, though.
Exactly, not on board, but across the global markets. And you've got these two titan billionaires, Michael Saylor and Peter Thiel.
Heavyweights, for sure.
Right. And their moves, they aren't just about, personal fortune or some kind of ego clash. They're actively shaping the whole narrative of Bitcoin's future.
Uh-huh. As a legitimate institutional asset.
Yes, we're talking billions of dollars on the line here. And really, the potential for a huge, seismic shift in how corporate finance works globally.
It's fascinating, a live experiment happening right in front of us.
It really is.
And what's really striking, I think, is that they're different philosophies. They aren't just, theoretical ideas.
No, not at all.
Both Saylor and Thiel are taking very real, very high-profile actions. They're pushing the boundaries of what companies think is acceptable or maybe even necessary for their balance sheets.
So on one side, you have Saylor.
Right, you've got this really aggressive accumulation strategy. And then on the other, there's this caution, almost a philosophical skepticism.
Well, not just talk, is it?
No, it's a real-world, high-stakes demonstration. Two profoundly different visions for, well, the future of money and corporate treasury.
Absolutely. And that's precisely what this deep dive is all about today. We're really zeroing in on Bitcoin's role, which is getting bigger, but is still, super debated.
As a corporate treasury reserve.
Exactly. Is it truly the ultimate inflation hedge? Is it this brilliant, long-term strategic bet, especially now with all this monetary expansion?
On the flip side.
Or is it, like some people suggest, just the early stages of a speculative bubble? Pumped up by corporate FOMO, that's fear of missing out, of course.
Just waiting for the pop, the painful pop.
Right. And you, our listener, you've armed us with a whole stack of insights today. We've got key debates, real-world case studies, hard market metrics.
A lot to get through.
Yeah. So our mission today is basically to cut through all that noise, look at these sources from, every angle, and just unpack it all for you.
Yeah, the goal is to give you a clear, balanced understanding. We want to look at the core arguments, from both sides of this really critical debate.
We'll dig into the potential impacts too, right? Not just on markets or Web3.
But most importantly, on investors like you. We'll look at the data, the stories behind these big corporate moves, and crucially, what it all means for companies right now.
Especially those trying to decide, should we put Bitcoin on our balance sheet? It's a huge decision.
It's a massive decision. This isn't just about understanding Bitcoin itself. It's about understanding a potential, paradigm shift in finance.
So get ready, because by the end of this, you should have a real shortcut to being incredibly well-informed on, honestly, one of the most significant financial discussions happening today.
It's definitely up there.
And hey, before we really dive deep into the material, just a quick ask. If you find this exploration valuable, please take a moment to like this video, maybe leave a comment with your thoughts. Tell us who you lean towards, Saylor or Thiel.
Yeah, we'd love to hear your take.
And, of course, subscribe to the channel, hit that notification bell. It genuinely helps support us, boosts our visibility. You know how the algorithms work.
It lets us keep making this kind of in-depth content for you.
Exactly. So thanks for considering that. Now let's really get into the heart of this thing.
All right.
So to really get a grip on this pivotal debate, we absolutely have to start on that billionaire battleground itself, where Saylor and Thiel are, essentially drawing these fundamental lines in the sand.
Representing two really distinct philosophies.
Yeah. On one side, you've got Michael Saylor. He's the very energetic CEO of MicroStrategy. And he's become, there's no doubt about it, the most vocal, the most unwavering proponent of Bitcoin as a corporate asset.
That's absolutely right. And Saylor's thesis, it isn't just simple, it's incredibly impactful. Almost revolutionary in how he's applied it.
What is it, boiled down?
Bitcoin is the ultimate corporate treasury reserve. That's his core message. And his argument, it really rests on this deep belief that Bitcoin is a superior long-term hedge against what he sees as, the inevitable ongoing debasement of fiat currencies.
He calls it digital gold, right?
He does, but he often argues it's even better, more robust. Saylor thinks that holding traditional cash, that's guaranteed to lose purchasing power over time. Because of inflation, because of central bank policies like quantitative easing.
Where they're essentially printing money.
Pretty much.
Yeah.
Creating new money, buying assets, often devaluing the currency. But Bitcoin, he says, with its hard cap only 21 million coins ever, its decentralized nature, its global access, it's uniquely positioned.
Not just to hold value, but to appreciate.
Exactly. To appreciate against this backdrop of fiat currencies losing ground. He often points to historical data, comparing Bitcoin's performance against gold or the dollar, especially during high inflation periods. He sees it as this superior, non-sovereign store of value.
And crucially, he hasn't just talked about it. I mean, he has walked the walk with this incredible, almost singular focus. MicroStrategy has just relentlessly executed this,
They have, accumulating over 200,000 BTC now.
which is staggering.
Yeah.
This isn't some small speculative side bet. It's a massive ongoing corporate strategy. It's basically turned MicroStrategy, which was a business software company,
Right, fundamentally a tech company.
into effectively a Bitcoin proxy company. It's stocked, MSTR. It tracks Bitcoin's price so closely now.
It really does.
It's just, wow, a testament to his absolute faith in its future. He's practically betting the company on this asset. And that highlights a fundamental shift, doesn't it, in how some people are starting to think about treasury management.
Oh, absolutely. Traditionally, corporate treasury is conservative, right?
Yeah.
Focused on liquidity, preserving capital, getting yield from low-risk stuff like government bonds or money market funds.
The safe stuff.
The safe stuff. Saylor directly challenges that. He's basically saying the long-term erosion of purchasing power you get with fiat currency, that demands something more resilient, something non-sovereign.
So his aggressive move is like a direct challenge to the old playbook.
It is a direct, tangible challenge. It shows that, for some people at least, the perceived risks of holding traditional assets, like cash, now outweigh the volatility risk of Bitcoin. The high-stakes redefinition of what safe even means for a reserve asset in the 21st century.
Okay. But then on the other side of this battleground, we have Peter Thiel, co-founder of PayPal, Palantir, notoriously sharp thinker.
Definitely no stranger to tech or crypto.
Right. He's a major investor in the space. But his perspective is much more cautious, skeptical even compared to Saylor's enthusiasm. He asks a different kind of question.
Yeah, one that gets right to the heart of economic utility. How so? Well, Thiel's skepticism mostly frames this large-scale corporate buying of Bitcoin as a potential bubble. His concern isn't really that Bitcoin has zero value. It's more that if corporate adoption isn't fundamentally tied to productive economic value, meaning it's not being used to, say, make supply chains better or enable cheaper international payments or power new business models, new apps. If it's not doing something productive, then its price could inflate unsustainably.
Oh.
He raises that critical question: what is Bitcoin actually producing for the economy? Especially when it's just held passively on a corporate balance sheet. For Thiel, if it's just a store of value or just a speculative asset, that's one thing. But it's a different calculation if it's actively contributing to a company's core business or generating revenue through its utility.
He wants us to look beyond just hoping the price goes up.
Exactly. He challenges us to look past just price appreciation.
That's a really crucial distinction, isn't it? Because it forces you to think about the underlying utility, not just the perceived value. If it's just everyone expecting the price to keep rising, that's one scenario.
Classic bubble behavior, potentially.
But if it's tied to some growing, productive economic engine, that's completely different. Thiel really pushes us to think about the why. Why hold it beyond just hedging inflation? What problem does it solve for the balance sheet itself?
Precisely. And his perspective, it doesn't completely reject Bitcoin. I mean, he's a huge figure in tech and crypto investing.
Right.
But think about it from a CFO's perspective. Cash reserves are usually there for operational needs, right? Paying bills, funding investments in the business, managing debt. If Bitcoin isn't actively generating revenue or cutting costs or helping the core business function beyond just sitting there as an inflation bet,
then its role as a primary treasury asset gets more complicated.
much more complex. It becomes an asset that needs justification, not just by potential appreciation, but by its practical contribution to the business itself.
And this is where it gets really interesting, I think, and shows Thiel's nuanced view. Palantir, the company he co-founded, accepts Bitcoin as payment.
Right, for their services.
Which is huge given Palantir's role. So it's not like he's saying Bitcoin is useless. It shows this very practical kind of mixed approach.
It does. It acknowledges Bitcoin has utility in certain contexts, maybe for payments, maybe for remittances, but it still maintains that measured concern about just accumulating it as a primary treasury asset.
So not the full Saylor strategy, but definitely not a total dismissal either.
Exactly. And that nuance is so important for you, the listener, to grasp. Accepting Bitcoin as payment, that integrates it into the business flow. From Thiel's view, that can be seen as productive. It enables a sale, right?
It facilitates economic activity.
Yes.
Yeah.
But holding huge amounts passively as a reserve asset without that direct operational link, that's a different calculation for Thiel that highlights that critical difference. Bitcoin is a transactional tool versus Bitcoin as a primary long-term treasury strategy.
Where its fundamental economic value, beyond speculation, is the main question.
That's the crux of his skepticism.
So, okay, why does this clash between Saylor and Thiel matter so much? For you listening, whether you're an investor, a business leader, or just curious about where finance is heading.
Well, it's not just some academic debate, right? Or just two smart guys arguing in the financial news.
Definitely not.
This is a clash between two billionaire heavyweights who are actively, right now, shaping how institutions view Bitcoin. Their words, and maybe even more importantly, their actions.
Like MicroStrategy buying more Bitcoin.
Exactly. Those actions carry enormous weight. They influence market sentiment. They influence corporate strategy all over the world.
And what's fascinating is how their opposing views just perfectly capture that fundamental tension, the core question about Bitcoin's identity.
Is it really this new digital gold, a non-sovereign asset, a hedge against currency debasement, inflation, geopolitical risk, something that should be in every treasury? Or, as Thiel suggests, is it fundamentally speculative, prone to those boom and bust cycles you see in bubbles, especially if it's driven by corporate FOMO and doesn't have that clear, underlying productive value?
It's not an easy question.
Not at all. And the answer has huge implications.
That really is the core question, isn't it? And the answer, it isn't just theoretical. It has very real consequences. The outcome of this whole narrative battle, it significantly impacts whether more big companies, Fortune 500 types, will follow Saylor's lead.
Will they start making strategic allocations to Bitcoin?
Or will Thiel's warnings make them hit the brakes, stick to more traditional, less volatile treasury plans? This really determines the future path of corporate Bitcoin holdings. It could trigger massive capital shifts globally.
It's not just about MicroStrategy anymore. It's about the entire corporate world's approach to risk and value in this new era.
And for you as an investor, the market watches these guys like hawks, right?
Absolutely. When MicroStrategy announces another big Bitcoin buy, it sends this powerful signal of conviction. It might encourage others to jump in.
And conversely,
when Thiel voices concern about a potential bubble, it makes institutional investors pause, reevaluate their risk models, do more due diligence. These aren't just opinions. They're market-moving statements. They directly feed into how Bitcoin's price is discovered and how accepted it becomes by institutions. Billions of dollars in investment decisions are influenced by this.
okay, so moving beyond just the hype of this billionaire showdown, let's think about the tangible impact. On corporate adoption, yes, but also critically on the markets. There's a strong bullish angle here, the one Saylor really focuses on.
Right, this idea of significant supply shocks and potentially huge price upside driven by this corporate demand.
Explain that. How would that work?
Well, this bullish scenario suggests that if more and more companies start doing what MicroStrategy does, treating Bitcoin not just as a quick trade, but as a strategic long-term reserve.
Like part of their core treasury.
Exactly. It fundamentally changes the market dynamics profoundly. What happens is these big corporate buys effectively lock up huge amounts of Bitcoin.
They take it off the exchanges.
Yes, it's moved off exchanges, out of active trading circulation, often put into secure cold storage. That means offline, maybe in hardware wallets. Very secure against hacking, but also not readily available for trading.
So it's like putting a rare painting in a vault, not hanging it in a gallery for sale.
That's a good analogy. This systematic withdrawal from the market, it has a real effect. It creates these significant supply shocks.
Because Bitcoin supply is limited.
Exactly. It's mathematically fixed, increasingly scarce, especially after the halving events that cut new supply creation. So any big reduction in the Bitcoin available on exchanges, especially if demand is growing from both retail and more institutions.
It just puts upward pressure on the price.
Immense upward pressure. Basic supply and demand kicks in powerfully. It's like that game, Musical Chairs, where the number of chairs keeps shrinking, but more players keep wanting to join the game.
And for you as an investor, this is obviously a key point to watch. If corporate treasuries really do start seeing Bitcoin as like a must-have asset,
it could mean a persistent drop in available supply against rising demand.
and that fundamental imbalance, well, it could potentially drive the price way higher over the long run. It makes a very compelling case for future price action if that trend holds.
But, and this is a crucial but, we absolutely have to consider the bearish caution too. And this is where Peter Thiel's concerns really hit home.
Okay, what's the worry there?
The worry is, what if his concerns are right? What if corporate FOMO, that fear of missing out, leads to this inflated bubble? A bubble not actually supported by underlying productive value or a clear use case beyond just speculation.
The consequences could be bad.
They could be severe, impacting a whole range of investors, not just the big companies.
Bubble is a word that makes everyone nervous, and for good reason. What would that actually look like for a company holding Bitcoin if the bubble pops?
Well, in a bubble, prices get more and more detached from any fundamental economic value. The main reason people buy is just the expectation that someone else will pay even more later. Doesn't matter what it's actually worth or used for.
Just pure speculation driving it.
Exactly. It creates this highly speculative market. And if the narrative suddenly shifts, or there's a negative event, maybe a big regulatory crackdown, or another high-profile failure like Luna Foundation Guard,
Which we'll get to.
right? If something triggers a sell-off, the results can be disastrous. A bubble like that, by definition, eventually ends in severe, painful corrections. Prices plummet fast, huge losses.
And those losses wouldn't just stay on the corporate balance sheets, would they?
No, they'd ripple outwards. They'd hit retail investors who might have jumped in because they saw the big companies doing it, thinking it was a safe bet.
So it's a critical warning. Manage your risk, understand the downsides, don't just get swept up in the hype.
Absolutely. And it raises that key question for any investor, big or small. How do you tell the difference between real, value-driven growth and just a speculative bubble?
How do you tell?
Well, Thiel's focus on productive economic value gives us a useful lens. It pushes us to look beyond just the price chart. What fundamental utility is Bitcoin providing in a corporate setting? If a company uses it for, say, instant global payments, okay, that's a clear utility.
It solves a business problem.
Right. But if it just holds it, hoping the price goes up, that's a different, much more speculative calculation.
So for you, the listener, the retail investor trying to navigate this, what should you be watching? What are the key signs? The clues that tell you which narrative Saylor's bullish long game or Thiel's bubble warning is actually gaining ground?
There are a few critical things to keep an eye on. First, pay really close attention to corporate balance sheets. You need to track how many public companies are holding Bitcoin, and crucially, how much are they holding?
Is the trend speeding up or slowing down?
Exactly. Is it accelerating, showing widespread acceptance? Or are we seeing more caution, like Tesla selling some, or maybe even companies divesting? You can often find this info in public company filings, their quarterly reports.
Okay, what else?
Second, watch the flows into Bitcoin ETFs, exchange-traded funds. These are regulated ways for both institutions and retail folks to get Bitcoin exposure.
So their inflows and outflows tell us a lot.
They're crucial proxies for broader market interest and institutional conviction. Strong, steady inflows suggest growing belief. Big outflows might signal hesitation or maybe profit-taking.
And finally, you mentioned narrative clues.
Yes, those are important too. Are major financial institutions putting out research that frames Bitcoin as a legitimate treasury asset? Are more central banks or sovereign wealth funds even talking about its potential role?
So it's about reading the room, institutionally speaking.
Right. These indicators give you vital signs of which way the institutional wind is blowing, where the market might actually be heading. It's about looking at the broader sentiment, not just the daily price swings.
Putting all those pieces together gives you a better picture.
A much more holistic, nuanced view than just staring at a price chart. It helps you understand the underlying market structure, the conviction of the big players, and whether this institutional embrace feels genuine and sustainable, or maybe just temporary.
Now let's zoom out a bit. Think about Bitcoin's ripple effect. Beyond just corporate balance sheets, across the wider Web3 ecosystem, and also the regulatory side of things. Because Bitcoin really acts as a sort of benchmark for the whole crypto space, doesn't it?
It absolutely does, yeah. It's almost like the reserve currency for the crypto world in a way.
Yeah.
So corporate treasury adoption of Bitcoin, it directly impacts the stability, the perceived value of other digital assets. It essentially lends credibility to the entire digital asset space.
How so? Give us examples.
Well, think about stablecoins. Their legitimacy often relies on the health and stability of the broader crypto market, and Bitcoin is foundational there. If Bitcoin is seen as a stable, viable corporate asset, that confidence kind of cascades down to stablecoins. Or look at CBDC's central bank digital currencies, those digital versions of fiat money. They might face pressure to be designed differently, maybe with more interoperability, if the decentralized asset like Bitcoin is already firmly established in corporate finance as a real alternative.
It sets a competitive benchmark.
It could. And then you have tokenized real-world assets like putting real estate or commodities on a blockchain. A validated, strong Bitcoin ecosystem provides a more trusted, more liquid environment for those things to actually take off.
Yeah.
If the benchmark asset, Bitcoin, is validated institutionally, the whole ecosystem gains this profound legitimacy.
So if Bitcoin gets that institutional stamp of approval through corporate adoption, it kind of accelerates everything else in Web3, moving things from just experiments into the mainstream.
It's critical vote of confidence, exactly.
Yeah.
It cascades through the whole digital asset world, and that leads directly to another huge implication, the push for regulatory clarity.
Ah, yes, the regulators.
It's one thing when it's just individuals holding crypto. But if major corporate treasuries start normalizing Bitcoin holdings, that creates undeniable urgent pressure on regulators everywhere to provide clear rules.
They can't just ignore it anymore, right? It becomes too big, too integrated into the financial system.
Exactly. Governments, financial authorities, they want certainty. They want stability. When a big chunk of the corporate world starts putting serious capital into a new, largely unregulated asset class, that ambiguity, it becomes a major problem, a huge risk, not just for the companies, but for the whole financial system.
So normalization forces their hand.
It essentially forces regulators to move past the uncertainty, to define clear legal statuses, figure out tax treatments, set accounting standards for digital assets, and this clarity is absolutely critical for more mainstream adoption, more institutional money to come in.
Because without clear rules,
Without clear rules, many large corporations who have strict duties to their shareholders, they'll just stay on the sidelines, no matter how much they might believe in Bitcoin's potential internally. Clear, consistent regulations, they de-risk the asset for traditional finance. They pave the way for much wider acceptance.
and with that clarity and that wider acceptance, we could see a whole wave of new financial products, right? Innovation usually follows adoption.
Oh, absolutely. What's really exciting is that widespread corporate acceptance wouldn't just be about buying and holding Bitcoin. It would likely catalyze entirely new financial products and services built around it.
Because companies need tools to manage it.
Exactly. Once companies hold significant amounts of Bitcoin, they'll need sophisticated ways to manage it, optimize it, leverage it, all in a compliant way. That opens up a massive market for financial innovation.
So what kind of innovation are we talking about, beyond just buying and selling?
Well, you could see things like dedicated corporate Bitcoin ETFs, designed specifically for treasury management. Maybe they'd have built-in hedging tools or specific tax reporting features to make life easier for big companies.
Okay, that makes sense.
We might see sophisticated yield strategies develop, tailored for corporate treasuries. Ways for them to earn returns on their Bitcoin through secure lending or derivatives, but with all the necessary compliance and risk management layers that traditional finance demands.
So making Bitcoin holdings productive in a way.
Potentially. And interestingly, even DAOs, decentralized autonomous organizations, governed by code and community, often holding large crypto treasuries, they might start mimicking Saylor's playbook for their own treasuries, developing more strategic asset accumulation and management approaches within their decentralized frameworks.
Wow, so it really could open up completely new avenues, integrating traditional corporate finance with Web3 capabilities.
That's the potential, yeah. A whole new frontier for financial innovation.
Okay, let's ground this conversation now in some real-world examples. We've talked a lot about the theories, Saylor versus Thiel, but what do the actual case studies tell us? Corporate, even national adoption. First up, obviously, MicroStrategy, the ultimate example of conviction.
Indeed. MicroStrategy's relentless buying, now over 200,000 BTC, it's the defining example of Saylor's thesis in action. It's not just an investment. It's a full-blown corporate balance sheet strategy, making Bitcoin the primary reserve asset.
And it's made the company a Bitcoin proxy in the stock market.
Absolutely. The company's stock, MSTR, shows this really notable, almost direct correlation with Bitcoin's price. It demonstrates how the market sees this strategy, how it impacts shareholder value.
Right.
For many investors, buying MSTR is buying Bitcoin exposure just through a corporate wrapper.
It's a live case study for that digital gold argument.
It really is a bold, high-conviction bet playing out in real time.
Then there was Tesla. A bit more cautious, maybe, a bit more nuanced. They bought big, made headlines, but then they also sold some.
Yeah, Tesla's a really crucial test case because it showed both sides. That initial $1.5 billion Bitcoin purchase in early 2021, huge signal. It drove market momentum, legitimized Bitcoin for a lot of people.
But then they sold 10%.
Right, and that sale, whether it was due to environmental concerns, testing liquidity, or just balance sheet flexibility, it showed that corporate adoption isn't always a one-way street. It's not always just endless buying.
It suggested companies might actively manage these holdings.
Exactly. Adapting their strategy based on market conditions, internal policies, maybe even public perception. It showed that conviction can exist alongside pragmatism. It added a layer of realism, reminding us that corporate treasuries often need flexibility.
So not necessarily the same unwavering conviction as MicroStrategy.
It demonstrated that for many companies, it's likely a strategic decision that can evolve, not just a fixed ideology.
Okay, moving beyond corporations now. We saw El Salvador actually adopt Bitcoin as legal tender, hold it as a national reserve. That took things to a whole new level.
El Salvador's move, starting back in September 2021, that's a unique, incredibly bold precedent for national-level treasury management. By making Bitcoin legal tender, a sovereign nation embraced it not just as an investment, but as a core strategic asset.
Integrating it right into the economy.
Yes. It signals this profound belief in Bitcoin as a tool for, potentially, economic sovereignty, maybe a hedge against inflation for a developing nation that relies heavily on remittances, a way to boost financial inclusion.
It's a huge national experiment.
It is, and many countries, economists, institutions are watching it incredibly closely. It challenges traditional monetary policy, offers a new model, but obviously comes with significant risks too.
Right. And speaking of risks, that brings us to a stark cautionary tale. The Luna Foundation Guard, LFG, they built up a massive Bitcoin reserve to back their stablecoin, UST.
And it collapsed spectacularly.
Yeah, what went wrong there?
The LFG case is just critical, a cautionary tale about Treasury mismanagement. And it really echoes some of Thiel's warnings about bubbles and mismanaging volatile assets. LFG bought billions in Bitcoin, specifically to act as collateral, to keep their algorithmic stablecoin, UST, pegged to the dollar.
The idea was Bitcoin's value would absorb shocks.
That was the idea. Keep UST at $1. But when the market got extremely volatile in May 2022, that massive Bitcoin reserve just failed. It couldn't prevent a catastrophic collapse of UST.
The death spiral.
Exactly, resulting in huge losses, mass liquidations, and a major blow to market confidence across the whole crypto space. It starkly highlighted the risks of relying on volatile assets for stability. It underscored the absolute importance of sound asset liability management, especially with something like Bitcoin, and the potential for systemic risk if things aren't managed with extreme care.
It's a powerful reminder, isn't it, that just holding a lot of Bitcoin isn't a magic bullet. The underlying design, the risk management, that's paramount.
Absolutely. Even the best intentions can unravel under extreme market stress. It showed that even Bitcoin's perceived stability can be undermined by poor design or just unforeseen market chaos. A lesson in humility for everyone involved.
And finally, let's circle back to Palantir. Co-founded by Thiel, the skeptic, yet they accept Bitcoin as payment. What's the significance there, especially compared to MicroStrategy or LFG?
The fact that Palantir, linked so closely to Thiel, accepts Bitcoin as payment, it's highly significant. It shows that even those with reservations about just hoarding it as a treasury asset, they still recognize some practical utility in Bitcoin.
It's a transactional approach.
Right. More practical, transactional integration, not a full endorsement as a primary treasury asset like Saylor argues for. It suggests Bitcoin has value as a medium of exchange, a payment rail, which, from Thiel's perspective, you could argue is a form of productive utility. It facilitates a real transaction for a real service.
But it doesn't mean they think it should just sit on the balance sheet as the main store of value.
Exactly. It shows a mixed, more measured strategy. One that values functional utility perhaps over speculative accumulation. It's a careful, pragmatic approach that might appeal to CFOs exploring digital assets without going all in like MicroStrategy.
So it highlights that crucial distinction again. Using Bitcoin for business ops versus making that big macro bet with reserves. There are nuances beyond just for or against.
Precisely. Pragmatic acceptance of function versus ideological embrace of treasury potential.
Okay, all these real-world examples really show the complexity here. But to truly get it, we need to go under the hood, right?
Yeah.
Look at some key metrics, what the data tells us beyond the headlines. Let's start with MicroStrategy again. It's stock versus its Bitcoin.
Yeah, this is really insightful, just observing the correlation between MicroStrategy's aggressive Bitcoin buying and its stock price, MSTR. It's often a powerful visual.
How so?
It shows the market's reaction to their treasury bet, how it perceives the impact on shareholder value. When Bitcoin goes up, MSTR often follows, and vice versa. This tight link shows the market has essentially re-rated MicroStrategy. It's seen as a direct proxy for Bitcoin exposure now, not just a software company.
So it validates Saylor's strategy in the market's eyes, at least.
For many investors, yes. It offers this live data stream showing how the market is constantly assessing that strategy. Is it creating value or just adding risk? Understanding that relationship is key to seeing how corporate Bitcoin holdings impact traditional stock markets.
Beyond just one company, though, how do we track the broader institutional move? Are more big players really getting involved?
Good question. For that, you need to look at charts showing the number of public companies holding Bitcoin over time. These charts give you that macro trend.
Is the adoption curve steepening or
Yeah.
flattening?
Exactly. Is it accelerating, suggesting widespread acceptance, or slowing down, maybe indicating caution after volatility? It gives us a quantitative feel for whether Saylor's vision is actually happening. And then you combine that with data on Bitcoin supply on exchanges.
Less Bitcoin available on exchanges.
Right. If the supply on exchanges is declining, especially while institutional accumulation seems to be growing, that's a powerful signal. It suggests a tightening market, potentially upward price pressure because there's less liquidity as more Bitcoin gets moved into long-term cold storage.
Into those offline secure wallets not actively traded.
Yes, it's that classic supply-demand squeeze potentially playing out. It indicates long-term holder conviction is maybe outweighing short-term trading. New entrants might be more focused on holding.
But, okay, any asset being considered for a corporate treasury, risk is paramount, especially for CFOs focused on capital preservation. How does Bitcoin stack up against traditional stuff like gold or stocks in terms of volatility?
Yeah, this is a critical question for CFOs and risk managers. You absolutely need to compare Bitcoin's historical volatility against traditional assets like gold or maybe the S&P 500.
And Bitcoin is way more volatile, right?
Significantly more volatile historically. While it offers potentially much higher returns, that volatility is a major hurdle for treasury managers. Gold, government bonds they're chosen for stability, low correlation to other assets. They're supposed to be safe havens.
Bitcoin hasn't really proven itself as a stable reserve yet.
It's experienced massive price swings, which makes its suitability as a truly stable corporate reserve asset complex definitely debated. This comparison helps you assess that trade-off, potential high upside versus much higher price risk. It's conversation happening in boardrooms for sure.
Okay, so volatility is a big factor, but can we get even more granular? Like a deeper, almost forensic view of what's happening on the blockchain itself? Market sentiment, investor behavior.
Absolutely. And this is where on-chain metrics are just invaluable. They offer insights you just can't get from traditional market data.
Like what kind of metrics?
Well, you can delve into things like realized price. That essentially calculates the average price at which all Bitcoin currently out there last moved on the blockchain. Gives you a sense of the market's aggregate cost basis.
So if the current price is way above the realized price.
It suggests there are significant unrealized profits in the market. Then there's long-term holder supply. This tracks Bitcoin that hasn't moved, usually for 155 days or more. It indicates strong conviction from holders who aren't planning to sell soon.
A rising long-term holder supply is bullish.
Generally seen as bullish,
Yeah.
Suggests strong belief in the future. And then you have whale accumulation. This monitors the big players, the whales buying large amounts. It gives insight into institutional or high net worth investor moves.
So if you see whales buying and long-term supply growing,
It suggests strong conviction from serious players. Potentially belief in future price appreciation, not just short-term trading.
wow, these are really the advanced tools then for understanding the true health and conviction within the Bitcoin market, giving you insights beyond just the daily price chart.
Exactly. They let you interpret the collective psychology of the market, offering a much deeper understanding of its structure and the motivations of its participants. Crucial context for understanding price action.
Okay, so for those listening who want to dive even deeper after this discussion, where can they find more of these insights, more research to keep learning?
Oh, there's a ton of great information out there if you know where to look. You can find excellent analysis comparing Thiel and Saylor, often breaking down their arguments in detail, on good crypto news sites like Cointelegraph or The Block.
What about directly from the source?
For direct corporate insights, MicroStrategy's official Treasury updates, usually in their investor relations section, are indispensable. You see their strategy, their holdings, right from them.
And more traditional finance takes.
Institutions like ARK Invest, Fidelity, they've published extensive research framing Bitcoin as digital gold, offering that traditional finance lens on the investment case.
And for those on-chain metrics we just talked about.
For that detailed market data, the advanced on-chain analytics, platforms like Glassnode and CryptoQuant, are really the leaders. They provide that granular data we discussed, realized price, holder supply, whale movements.
What about the big picture, global policy view?
For that broader economic and policy perspective, look for papers from international bodies like the Bank for International Settlements, the BIS or the IMF, the International Monetary Fund. They often discuss Bitcoin's role in corporate and sovereign treasuries, giving you that macro view of its implications for global finance.
So plenty of material out there if you want to dig deeper. No shortage of resources for you to really become an expert yourself.
Definitely. The information is available.
All right, and there we have it. We've taken quite a journey, haven't we? Through this fascinating high-stakes debate. Saylor versus Thiel on Bitcoin as a corporate treasury asset.
We really covered a lot of ground.
We've seen those powerful arguments for Bitcoin as digital gold, right? The hedge against inflation, fiat debasement, all backed up by MicroStrategy's incredibly aggressive, conviction-driven strategy.
And then we contrasted that with the equally important warnings. Thiel's concerns about a speculative bubble where prices might get detached from that underlying productive value.
We looked at the real world, too. The diverse examples. MicroStrategy's unwavering buying, Tesla's more cautious, flexible approach. Even El Salvador's bold national strategy.
And we didn't shy away from the cautionary tale either, the Luna Foundation Guard collapse. A stark reminder of the risks involved, the need for sound management, and how things can go wrong even with Bitcoin involved.
So considering everything we've discussed today, the bullish potential, those bearish warnings, the real-world experiments playing out right now, and what do you think?
Yeah, where do you land on this?
Is Bitcoin just an inevitable part of future corporate balance sheets? A fundamental layer for this evolving Web3 world? Or is its volatility, its speculative nature, just too risky for widespread mainstream corporate adoption? Could it lead to that bubble Thiel warns about?
The answer is probably pretty nuanced, right? Understanding both the transformative potential and the inherent challenges.
Exactly. It's a question that's going to keep shaping financial strategy, investment decisions, the very future of money for years to come.
It really forces us all to rethink some fundamental ideas about financial management in this rapidly changing digital economy, weighing old risks against new opportunities.
Absolutely. Now, before you go, if you found this deep dive valuable, and we really hope you did, we'd be incredibly grateful if you could just take a quick second.
Yeah, it really helps us out.
Like this video, maybe leave a comment below. Tell us your thoughts on the Saylor versus Thiel debate. Who do you side with? Or what other questions does this raise for you?
We genuinely read the comments and appreciate the discussion.
And of course, if you haven't already, please subscribe to the channel and hit that notification bell. Your engagement, honestly, it truly helps support us, boosts our visibility in the algorithms.
And it allows us to keep creating quality, in-depth deep dives just like this one for you.
So thank you so much for joining us today.
Thanks, everyone.